Good evening, everyone. And thank you for coming this evening, although I think you're going to find you're going to have a really interesting time. My name is Laura Kilcrease, and I'm the entrepreneur in residence at the Kelleher Center for Entrepreneurship, Growth, and Renewal. And I'm absolutely delighted to have with us Jim Lussier, who's the head of Dell Ventures, managing director and head of Dell Ventures, who's generously come in from the West Coast to be with us tonight. Let me tell you a little bit about Jim. Jim leads Dell's venture investing activities company-wide and is responsible for setting Dell's overall investment strategy and with navigating the ecosystem for entrepreneurs and venture capitalists to determine how Dell can add the most value. Prior to joining Dell, Jim spent a decade as a general partner at Norwest Venture Partners, a global venture capital firm based in Silicon Valley. Before that, he managed the high-tech strategy practice for Accenture, was vice president and general manager of a division of Beyond.com Corporation, and held executive positions at Metaphor and Booz & Company. Jim holds a BS in finance from the Wharton School of the University of Pennsylvania and an MBA from Stanford. Jim, thanks so much for being here this evening.
You're welcome. I'm delighted to be here. I look forward to sharing my thoughts with you.
Thank you. Jim, if you don't mind, let's start by you telling us a little bit about your life, both as a venture partner in a traditional fund and your entrepreneurship life before that, perhaps.
Sure. Maybe the best way to do it is to kind of go backwards, right? So I joined Dell about 3.5 years ago, and we'll talk a little bit about Dell and then what we're doing at Dell and the venture side of things. But before that, as you said, I spent a decade as a general partner at Norwest. Norwest is a $3.7 billion fund with 80 portfolio companies and 16 partners. And before that, I was also, as you said, I managed the high-tech strategy practice for Accenture, and in between, managed a division of an e-commerce company called Beyond.com that went public. So it's a mix of management consulting and strategy, entrepreneurship, general management, and venture capital investing. And what attracted me to Dell was, having that background in those diverse areas and also knowing a little bit about Dell and realizing that Dell is a company that's going through an enormous transformation right now. Michael came back in as chairman 5 years ago, and with that he set in motion a transformation from Dell as the PC software company that started here on UT's campus that we all know and love to really being a major systems company, right? And in order to do that, Michael knew that he was going to need to get into a lot of new businesses. He knew that he was going to need to build out around our server and PCs, and that led to a really aggressive acquisition and M&A thrust. Dell acquired something like 25 companies over the last 5 years. But Michael knew that that wasn't going to be enough. We were going to need to use some other tools to access innovation. And so that led to the idea of him forming a venture group. And me having been a partner in a venture firm and having seen the venture business from that side, and then the opportunity to go from being one of 16 partners in this global venture firm, which has been fantastic, to the person with the role of setting up and leading this venture capital opportunity in the middle of this platform. A $57 billion company with $11 billion in cash going through this transformation just struck me as a really exciting and interesting opportunity that I could bring a lot to.
That's fabulous. So, if you don't mind, tell us a little bit more about the Dell Venture Fund and your goals and what you want to achieve with it.
Yeah, sure. So, let me start with the vision. Right?
Please.
What are we trying to do at Dell Ventures? And we actually went back and revisited this just a few weeks ago, as we're 3 years into this now, and we're looking to take it to the next level. And our goal really is to be an enduring, and each one of these words has meaning, an enduring, world-class corporate venture organization that helps Dell achieve its goals through a combination of delivering strategic impact, delivering strong financial returns, and also ensuring or assisting in the success of our portfolio companies. And every one of those words has a meaning, right? Because corporate venture organizations come and go sometimes. There are only a few that have stood the test of time and that have been investing for 10, 15, or 20 years. And you know, before I came here, I really studied some of those other groups and looked at putting some of those key success factors in place as part of our strategy. So we want to be here for the long term. We want to be world class. We want to be able to help Dell achieve its strategic objectives. And at the same time, financial returns are just as important. And we can talk, I'm sure you're going to want to talk more about that. But how do we deliver strategic impact? How do we generate strong financial returns? It's by actually finding the best entrepreneurs. And the way you find the best entrepreneurs and get the opportunity to fund them is by delivering value to them through your reputation. And so, you know, we firmly believe that we've got to be delivering value to, you know, to the folks that we work with. And so, you know, some people will say, well, this is probably your next question, you know, why should we take capital from Dell? There's so many other sources of capital out there that the top entrepreneurs have. And our model is actually to partner with VCs like Norwest or Sequoia or Accel or Benchmark or Greylock and so on, not to compete with them, but to collaborate with them, let them bring the value that they bring, which is that combination of, you know, company building, you know, board management, executive recruiting, the governance around audit committees, compensation committees, and so on, and the CEO coaching, and we bring the value that we call it more than money, and we think is somewhat unique to Dell, and certainly different from what the VCs can bring. And that's our brand. It's a pretty well-known brand. You know, certainly, you know, think of the venture firm that you know the best, the top one in Silicon Valley or wherever, and that brand may be well known to you and to the entrepreneurial community, but when you get out into the middle of the country, people may or may not have heard of that firm, but they certainly have heard of Dell. So we confer a lot of credibility to companies that we invest in. We also have, of course, our 10 million business customers. Customers is one of the hardest things for startups, is to find those customers, and we can provide access to that. We have our 20,000 salespeople, our channel and go-to-market programs that we can bring and add value, and so on. So we think there's a lot of value that we can bring. Our model is to invest in early to growth stage companies. So we're a bit stage agnostic, but where we can help the companies the most is, even though we have seeded some companies, and I can talk more about that, because we really do think we can help companies at all stages of the life cycle, but Series B and Series C would probably be our sweet spot. But again, stage agnostic. We've got a $300 million fund that we announced at Dell World about 15 months ago now, and the areas that we're investing in include storage, data center, security, big data, mobile, and cloud computing. And so maybe I'll leave it there. I could say more, but that's a little bit more about what we're doing at Dell Ventures.
Thank you. Just delve a little bit more on that. When you decide strategically there's a deal that Dell Ventures wants to get into, do you look for an internal champion in the company? Are you guys the champion? How do you match them up with all the value that you can bring to this investment?
No, it's an interesting question and something to think about when you're setting up a corporate venture group, because you can range anywhere from being purely financially oriented, just like a financial VC, and there are some corporate venture investors that do, all the way to purely strategic, where you don't care anything about financial returns as long as there's a fit with the business. And we're somewhere in between. We really care very much about the financial returns. We want to earn financial returns that are competitive with what other VCs might experience in the market, but you have to have that and a strategic fit. And so we spend a lot of our time in each of those areas working with the business units very, very closely to understand, you know, where is the R&D going to be spent in the company. And you never have enough engineers, though. You just never have enough engineers. And so where are the gaps between what you can do internally and where the market's going and where the technology's going? And those become the areas where venture capital can really make an impact. And then one of the things, and I don't know how many of the other corporate venture groups do this, but what we do, and it's really working really well for us, is we have really a dedicated cross-functional team for each of these areas. So it's not just us finding storage deals or data center deals, but we form a cross-functional team involving Dell Ventures, corporate development, our strategy office, our CTO office, and the product management, the engineering and product management teams. And we meet just like a VC partnership. We meet once every week or every 2 weeks. And the first step is to define those priorities that I've talked about, those areas. And then what we like to do is proactively reach out to the entrepreneurs in those areas, whether it's Flash or whether it's vertical analytical apps or next generation data center operations. We reach out to those, we do the research and we reach out to those entrepreneurs. And I don't know how many of you here have an entrepreneurial background. How do you like the idea of getting a call from a venture capitalist who's actually done some research and thinks what you're doing is interesting?
Pretty nice.
A lot of hands are going up, right? And so that proactive approach, I think, and that focused approach on where we think the venture capability can add value to Dell, and then consequently where we can help that portfolio company is really how we approach it.
When you look and evaluate that company, do you spend a lot of time on the intellectual property? And Jim, I asked you this with a perspective of the Harvard Business Review wrote recently, actually, that corporate VCs in the acquisition or the investments they're making through their venture funds are yielding, on average, 3 times the patent portfolio that they would for the same amount of internal dollars had they been spent. That was a survey the business school had done. Is that important to you, the intellectual property, other than as a barrier to entry or something unique for the corporation? Or is it just another part of the equation that you're looking at?
Well, the technology is probably the most important thing, and our CTO office and our engineering group will go very, very, very deep on the technology. And I think, it's out of that deep technology is where the patents can come. So, in my mind, the fact that there's triple the number of patents coming out of venture-backed portfolio companies that are maybe ultimately acquired versus internally is just, evidence of the kind of efficiency that corporations can get by using venture capital as a tool to access innovation. After all, no matter how big your company is, there's more smart people outside your company than inside your company, right? And so the more that you can do to access and mobilize those people, the better, I think.
Great. Yeah. Thank you.
But patents, actually, we don't spend a lot of time thinking about it, to be absolutely candid with you. We do have an IP group that reviews that. We do some checks on it, but I wouldn't say that's a primary objective of ours.
Jim, as you get into finding a deal that fits the corporate strategy, you believe will have the financial returns, you start going through the due diligence stage with the different components of the company. Is there a typical time frame for you at Dell, or is it much the same as anyone else, would you say?
Well, yeah, I'd like to say we can move quick. I'd like to say that it's not significantly different from anyone else, and at the same time, we do have a process, right? And so I'd say 4 to 8 weeks would be typical for us, unless we have to get a transaction done in 3 weeks, in which case, we'll look to get that done, or if we run into issues in due diligence, which we sometimes do, it can take quite a bit longer. And some of these are relationships that, you meet the entrepreneur, they're not even raising money at that point, and especially given our proactive approach. And so there's no real fixed time frame, but probably 4 to 8 weeks is a reasonable time frame.
That's not very long at all.
No.
For a $57 billion entity.
Yeah.
Is that, actually, I'd say that's very fast. That's even fast for a separate $300 million entity. So really, it's remarkable. So you're there to get the job done, not waste anyone's time. How, if they want to approach you, should an entrepreneur approach you if they think there's something of mutual interest? Or do you solely go and find them?
Well, I'd say, actually, I mean, we do have this proactive approach, but it's probably, a third, a third, a third. A third is the proactive approach. A third is, as we're out there networking with VCs in the Valley, and we do things like road shows where we will bring senior executives from Dell out to Silicon Valley or Boston or Israel and meet with VCs and they love to hear kind of what people that are running multi-billion-dollar businesses are doing and how they're doing it and what challenges they're facing and what some of the holes are that they see in their product lines. And then we get the insight from them around what are the companies that are in stealth mode that they may not yet have announced. And so we're able to, to gather the intelligence that way. And so, that's kind of how we're out there networking.
So any vehicle is a way.
Yeah. So it's the outreach, it's the networking, and some of it just comes in over the transom, and that's I think what you're asking about,
yeah.
Right? Which is how, if someone isn't already funded, or if someone isn't already kind of on our target list, how do you get it? And it's probably the same as just reaching any VC in general, a warm introduction, right? So LinkedIn, it's an amazing tool. It's probably 1 or 2 degrees separation from anybody in the venture team at Dell and probably most of the people in this room. And so find someone, that knows us well and that knows what you're doing and has a lot of respect and can speak highly of it. And that almost always leads to a review of the business plan, if not a meeting.
Jim and I had never met before tonight, but I was amazed because I went to LinkedIn and found how many people we mutually know.
Yeah.
And so I can only endorse what you've just said.
It really is a small world when you get into the entrepreneurial community. And I'll just give you a little story. It kind of goes back to kind of Dell and Norwest and so on. Norwest is known for a lot of companies, a lot of investments, including going all the way back to PeopleSoft and Tivoli and Brocade and Extreme Networks and companies like that, and more recently, companies like Rackspace and Life Size Communications, which is a company right here in Austin that was recently acquired by Logitech, and I understand that Craig Malloy gave a really good talk here recently. Another company is FireEye that just went public not long ago in the security space, Lending Club, and Retail Me Not, which is another company from around here, more on the consumer side. But another company is Case, and Case is a systems management appliance company that we funded at Norwest, and turned out it got acquired by someone, of all people, Dell. And so I have the really interesting experience of getting to know the founders of Case from the time when they just started the company up until the time they sold it. Mm-hmm. And this was even before I had transitioned over to Dell. And so when I started at Dell, they said, hey, Jim, you've got to set up your offices right here in the Case office in Silicon Valley in Mountain View. And so it's just one of these small world stories where it's kind of the same people all the time, just you just change T-shirts from time to time, and it's kind of nice that, Norwest funded Case, which Dell acquired, and now Case incubated Dell Ventures.
That's
right.
That's fabulous.
So it is a small world that way.
As the world turns in the funding ecosystem.
Exactly.
Talking about the funding ecosystem, let's move on a little bit to, corporate VCs. We've seen this enormous growth in the last 4 years. Right. Supposedly there's 475 new corporate funds in the last 4 years, bringing the worldwide total to about just over 1,000 corporate funds. That's in itself an enormous growth. Do you think this growth is going to influence the kind of funding ecosystem, and if so, how?
Yeah. Well, I've said that corporate venture tends to be boom bust, and probably one of the most dangerous phrases that you can hear about any kind of an investment scenario is, you know, yes, there's a boom now, but it's different this time, right? It's different this time. What we saw, you know, it isn't going to happen. But, you know, having said that, I think it still is, you know, quite similar in many ways, but there are some things in the environment that have changed that are really leading to this increase in corporate venture. And as we go through another cycle, which we inevitably will, you know, we're going to see the staying power of a lot of these organizations that have been set up, but I think those that kind of take an approach for the long haul, like we think we're taking, will be there for the long term. I think it's often said, you know, you're going to be there for the long term if you survive 5 years or 3 CEOs, whichever is first. But we're fortunate at Dell because we've got Michael as our founder and CEO, and now that the company's private and he owns 75% of it, doesn't really look like he's going anywhere.
Okay. Well,
so we're fortunate in that score.
He's kind of been pretty steadfast with the company for a long period of time.
He's been yes, all the way back to the founding in the dorm room right here at UT. And he is, and that's, you know, one of the things that's really key is having someone like him in the CEO office that's so supportive of entrepreneurship and so supportive of the venture group. You know, but back to your question, you know, what's driving this?
Yeah, what's
this
driving?
This explosion in corporate venture. And, you know, the numbers I have show that it's gone from something like 6.5% of all dollars back in 2009 to about 18% last year. So there's been, you know, not quite a tripling, but, you know, just as a share of the dollars, there has been this increase. And admittedly, 2009 was a low year. That was, you know, that was a bad year. But still, I think it's three factors that are driving it. You know, one is the corporations themselves and the need that they have to access innovation. And we talked about how M&A is a tool. We talked about how your own engineering is a tool. But venture is yet another tool that corporations can leverage. And I think some of the statistics you cited earlier, you know, suggest that corporations are increasingly realizing the kind of the efficiency, if you will, of the R&D dollars that are out there in the entrepreneurial community, and the disruptiveness. I mean, most of the new breakthroughs are more likely to come from startups than they are from within your own R&D lab. So you got to pay attention to that. I think that's one thing. Another thing is just the restructuring in the venture capital industry itself. You know, we had a real rapid expansion of the industry up to 2000. It went from something like $5 billion in 95 to $100 billion in 2000. I think you probably have all seen those stats. We all lived through those times. It was crazy. It was fun while it lasted. But it then really crashed. When the market crashed, it went down to about, you know, 20 billion or so, something like that, maybe even a little bit less than that. And gradually has rebuilt itself up from then. But in that process, there's been a really, really painful and interesting restructuring that's happened within the venture capital industry itself. And so more and more of the capital is concentrated in the top firms right now. And there's a lot of smaller firms, middle-sized firms that, because of their track record, have been unable to raise new funds. And so one of the knocks against corporate venture used to be, oh, those corporate folks, they'll be there, but then they're a little bit unstable, you never know. Well, that's as true or more true with the venture capital community, unless you're really going with the very, very top firms that have the track record and have been there. So suddenly the scales tip a little bit when you're looking at going with a financial VC versus corporate. So there's the corporate demand, there's the changes in the venture capital industry itself, but probably most important of all is the entrepreneur. And the entrepreneur always has a choice of where are they going to seek their funding from. They can seek, and the best entrepreneurs have more choices than anyone else. And increasingly what we're seeing is that the entrepreneur is realizing that there's a lot of benefits that corporate investors like Dell can bring to the table that aren't available elsewhere. All of those things that I talked about that are somewhat unique to the corporate sector. And I think those are going to be there for a while.
Yeah. Well, last year, the numbers came out, $48 billion invested,
Right.
which roughly between 8 and 9 billion was from the corporate sector.
Exactly.
Which is absolutely key. But the corporate sector brings another benefit when it comes to investing.
Right.
The stats show that a corporate venture capitalist, overall, about 20% of the deals they invest in, they actually end up acquiring. Versus, not necessarily that amount. I'm not sure how accurate some of the statistics are. They actually come from some research done by an entrepreneurship publication in December. But there is that opportunity, shall we say, to get to know through the corporate venturing investment the corporation itself for potentially an exit, not a guaranteed by any means.
Yeah, and you mentioned as we were talking about getting about this session that you wanted to know a little bit about the criteria that we use, and this leads to the idea that is the acquisition potential of a company something that is very, very high on our list, and the answer to that is no. It's not. Those numbers, that number's a little higher than I might have expected to be, as high as 20%. We look to invest in companies because there's an opportunity to make strategic impact. And I'd like to give you a couple examples when we get a chance. I want to answer this question first around some investments that we've made and how we define strategic impact and the kind of strategic impact we've made. But when we make these investments, we're not looking at, we're only going to invest in companies we can acquire. We're looking to invest in companies where we can make strategic impact, defined as the opportunity to learn about a space that we have an interest in but haven't yet necessarily committed to get into, or the opportunity to fill a hole in our product line that we have. We have a lot of IP over here, but we've got a gap over here, and where we can do a commercial arrangement with the company that will allow us to fill that hole, allow them to leverage our channel, and so on. And those are more of the reasons. Now, does that mean that we're never going to acquire any of the companies? I can't comment on that on camera, but no, it's one of those things where that's always a possibility, and it's something that could very well happen.
So
but I don't have any announcements today on that.
And for those of you who have questions, please go to the mic. I'm going to ask another question, but if you're thinking of something, please go to the mic so we know you have a question to ask. So with the trends that we've seen in the corporate venturing world, we saw a trend in the late 60s of a bunch of corporate VCs that kind of went away. We had another trend in the mid-80s, kind of went away. And then, of course, the late 90s was a trend where, just private VCs, everyone got caught in the bubble. With the advent of this growth here, do you think we are in another trending phase? I mean, we've clearly seen the growth, but we've seen, a 47% growth in 4 years. That's really pretty remarkable. Do you think it's still continuing to trend in a worldwide basis, Jim? Meaning, if you think back to the 60s and 80s and so forth, and I want to add, neither Jim or I were around at that time. We were very young. But
that's what I heard about it.
Thank you. Yeah. But when you think about those times, the whole venture concept was more a North American kind of concept than it even was a European concept. Yeah. Now we're into worldwide flow of capital, and certainly a growth, outside of North America. Do you think this trend might continue in other parts of the world?
Well, it's interesting. There is certainly, more venture, as venture capital rebuilds from the low base in the mid-90s, there is more venture capital everywhere in the world. But that said, and we look at these statistics really, really closely, somewhere between 2/3 and 3/4 of all VC is still in the United States, right? And of that, roughly 2/3 is in Northern California, right? So venture capital continues to be an extremely concentrated industry. There are pockets of innovation around the country, Boston, New York. Austin's got an emerging and burgeoning, entrepreneurial community. But still, there's a set of conditions that are in place in the entrepreneurial centers that are hard to replicate. And as we thought about building companies, and we had lots of opportunities at Norwest, and we have lots of opportunities at Dell to look at building companies outside some of these centers, it's difficult, it's challenging. And I think that may, because there's not necessarily the talent, the infrastructure, just enough career opportunities for people to move from company to company, the culture of being able to fail and get back on your horse and start a new company. There's just a whole unique set of things that make it, I think, more challenging to do elsewhere. So yes, I think these areas will grow, but I still think that the centers that we see now are going to continue to predominate.
That's great. So when we think about these areas,
yeah,
and the ecosystem, certainly Silicon Valley, how many years can you say it's old? 40 years by now, 45 years. You've got these serial entrepreneurs.
Sure.
And at one point, a serial entrepreneur was a rare commodity.
Right.
Austin is now building its serial entrepreneurial ecosystem, people that have been successful more than once.
Right.
You mentioned one earlier on, Craig Malloy.
Right.
Is a great example. Some of the founders from Tivoli,
right,
et cetera. So now, there's a period of time, and I would estimate that for us it was 12 to 18 years in that period of time. Mm-hmm. Do you look forward to emerging centers as places to look for new and raw and different talent outside of the major centers? Obviously the major centers make a lot of sense from a time perspective and
right,
efficiency.
Right.
But how about some of the newer ones, perhaps Seattle, Boulder,
yeah,
Austin?
Well, the answer is we will be finding opportunities in all those centers, but the lenses that we look at, it's a little bit different.
Mm-hmm.
As I said, we're looking at where are the gaps between where the markets are going and what we can do internally. And then we do our research, and we don't care where those companies are. They could be anywhere. And so we do scour the landscape, and we do look outside, strictly Silicon Valley. And at the same time, it does seem like, on a percentage basis, more of them are there than elsewhere. But mm-hmm, still, we're open.
You're open.
We're open, yeah.
I found it interesting that 25 of the top 30 firms in the Dow Jones Industrial Average Index have their own venture funds. I haven't yet found out the 5 that haven't. I need to find them.
And they're probably no longer in the Dow Jones.
They might be coming out the Dow Jones. But it's an interesting, when you think about
yeah,
the measurements that we have, that again, as you said earlier on,
yeah,
these firms are using their tools. So, do we have questions? So.
Yes, Jim. My name is Harvey Fry, and along the lines of the discussion of sourcing and where you do funding, what percentage, either by dollars or by numbers of invested, do you do in the U.S. versus international, and how in the evolution of your role in Dell do you see that 5 or 10 years from today? Mm-hmm. There's obviously going to be a lot of change globally, and that'll affect where your gaps are as well as who's able to provide innovation.
Yeah, well, we're just getting rolling, right? I mean, we've been at this for 3 years, going on 4. We've got 15 companies in the portfolio, and I'd say that most of them are in the United States. I think we have 1, maybe, or 2 that are outside the United States. Where do I see that going? I'd like to see, what I'd like to see is, Dell with a venture capital, with staff, not only here in the United States, but around the world, in China, in India, in Israel, in Europe. I think those would be the places that we'd like to eventually go.
Israel's a small market, high, intense technology, technology rich,
yeah,
but a relatively small market.
Israel's like Boston, right? It's about the size of Boston, right? So, if you look through the centers in the United States, it's San Francisco Bay Area, you know, with, you know, probably half of all venture capital in the country. Boston is next with 10 or 20%. Israel is another 10 or 20%. So as you look around the globe, it's actually a pretty decent center. It's a small country.
Small country.
But it's extremely innovative. And there's probably an outsized percentage of the kind of technology that Dell is looking for in Israel, right? Mm-hmm. Because we're not investing in consumer right now. We're not investing in energy. We're not investing in medical. What we are investing in is enterprise infrastructure. And Israel is really, really strong in cybersecurity. They're strong in storage. They're strong in a lot of the technologies that turn out to be, you know, pretty important to us, to Dell. Yeah.
That's great. Dell clearly has been growing its overseas operations in Asia, specifically China, over the last number of years.
Yep.
Is that a different kind of challenging environment, or is it just like we have here in terms of, you know, much bigger population, merging perhaps in some of the issues around intellectual property, et cetera, but an enormous marketplace?
It is an enormous market, and the way we cover it is through, we've got our direct investments, and I told you that we have 15 or so of those in our portfolio, but we also have some investments, and we don't talk a lot about this publicly, in some venture funds. And one of those funds is based in China, and so that's kind of our window into China. And so we look to them to help surface opportunities and investments that could be a good fit for us. And a lot of the companies that we look at, you know, given that most of them are US based and given that half of the IT spending in the world is in North America, tend to start here first. Yep. But then a lot of them do look to China as a customer, more as a market, as a, you know, more as a market. And sometimes we'll pull in syndicate partners who have a particular expertise in China. And I can think of two companies where there are firms that are, you know, based in China, mm-hmm. that bring everything that it takes to be successful from a venture standpoint, whether it's government connections and understanding of the regulatory environment and the political environment and even the capital market environments, which is very different, and, you know, much more highly regulated than here. Yeah, so that's kind of how we view that market is something that we're going to be partnering with. Partnering to enter.
Thank you. So,
I'm Britt Talbert, and you mentioned you've been at Dell for about 3 years, so I was wondering if you could talk a little bit about the internal team as far as building that. Did you look primarily in Dell or outside to venture capital experience, that sort of thing?
Yeah. So it's a small team, it's a hardy team, and it's really a mix of internal and external folks that we have. And it's split between the Bay Area and Austin right now. And so, you know, obviously I come from the outside. We have another director in the group who's out in the San Francisco Bay Area who came to us through an acquisition that we made and who also has some great experience in consulting, in cross-border investment banking between the U.S. and China, as well as in venture capital. Mm-hmm. So that's a really great, I would call it an outside hire. And then we also have here at Austin, we're leveraging, you know, folks that have come up through our various development programs, are spending time in corporate development. We are part of corporate development. And so we've got a matrix organization where we've got a dedicated team that is devoted to the venture group, but then we matrix and leverage our corporate development professionals. A lot of them come out of investment banking, and we cross-train them in the venture disciplines. So it's really a mix.
Jim, historically, the venture industry was an industry where basically it was an apprenticeship. If you go back to the 80s, 70s, 80s, it was an apprenticeship business. You came in young, you joined a firm. Over many years, you learned the art and the skills of the business, and perhaps worked your way up. It seems to me that in the 90s, we kind of lost a lot of the apprenticeship side of the business with the advent of a lot of emerging funds. Do you think now with the the size and number of corporate venture funds, we'll get back into some of that apprenticeship type training for our teams. That may not be the...
Absolutely. Well, I think it's always, it's been an apprenticeship business, and it probably always will be an apprenticeship business, and we've embraced that at Dell. It's a lot of it's about pattern recognition, and my team and I spend a ton of time developing courses, and so we've got VC 101 and we've got VC 201 that we've developed, and we're about to teach a course, since we're in education, with special topics in venture capital. Actually, we're going to be teaching that tomorrow, where we're really, trying to package that knowledge, that apprenticeship type knowledge, but that knowledge only goes so far. You have to do it, and I'd say in corporate development, we've got at any given time probably 12 people that are working on transactions today.
That's a lot of people.
Yeah.
That's an awful lot. I mean, when you think about the amount of transactions,
Yeah.
so you obviously see a lot, and there's a lot of deals that you don't fit your criteria.
Right.
Other than saying no, how do you handle those? I mean, is it, hey, it's not for us now? Is there a penchant to try and redirect the deals to someone that might have an interest in that area just because your team happens to know? Or if the deal's not quite ready for you, how much work will you...
Well, the question of the criteria is a really interesting one as well, and maybe we can come back to that as well, because I actually have a whole course on what do you look for in an investment, and maybe how does it differ from corporate versus financial. I could give you the nickel the nickel version of that tonight, because I'm actually pretty passionate about that topic. You only are going to be able to invest in 1 out of every 100 companies that you come across. I mean, that's pretty much the odds. And so then, and you don't meet all 100. A lot of them you'll review in a paper screen, and you'll turn them down at that point. But our philosophy, what we really try to do is, even if it's a turn down, is try to add value in some way. It's rather than just simply not respond, and some VCs have a reputation for doing that. At least get back with here's what we think, and here's why we think it's something constructive. We like the team, we like the market, but we were concerned about either the stage of the company or the lack of customer traction, or come back to us with this and that. And if we do have a referral, if we know of someone that is actively investing in that area, we'll send it on.
That's great. So,
I think you have to respect the entrepreneur. That's part of what it is to build a brand.
yeah.
Hi, Mr. Lussier. I was wondering, when your company, Dell Ventures, invests in a certain company, are you guys, what are the terms you guys are looking for? Is it more on the equity side, or returns, or what other factors are there?
Yeah, I mean, as I mentioned, our strategy is to co-invest with top VCs, and so we will tend to join a syndicate of investors on the terms of that round, which tend to be very much financial in nature, and focused on a fair valuation that we think can generate an appropriate return on investment above our hurdle rate, and the kinds of preferences that protect our capital, the kind of voting rights that allow our series to have, the appropriate amount of influence over the company. We also ask for board observer rights, so we don't take board seats. Most VCs do. It's our preference to allow the VCs to sit on the boards, and we prefer to avoid the liability that's associated with that. But we can still influence the company through board observer rights. Information rights are key. And the other thing we often ask for is a right of notice, so that in the event that, especially if we're going to be spending a lot of investment in a company around a commercial transaction and adding a lot of value to that company, if there is an acquisition offer that comes in, we at least want to know about it rather than read about it in the paper, so that we have a chance to put our best foot forward and acquire the company if that's something that makes sense.
Thank you. Sir?
Hi. Can you just share your thoughts on valuation in the industry today, and are we in a bubble, and if so, how long will it last? Thanks.
The billion-dollar question.
Yeah, are we in a bubble? Are we in a bubble? I thought I was able to avoid that
I didn't ask it.
in the earlier line of questioning. Well, one thing we know about markets is that they fluctuate. One thing we know about markets is that when they're high, they correct at some point. You know, my sense, and of course it depends on the sector, right? But I'd say that in certain sectors, the valuations are higher. They're on the higher side relative to what they've been historically. There are certain signs and parallels that we see from 2000, you know, where you have, buy side financial institutions in the mutual fund industry, you know, coming into IPOs earlier, or hedge funds getting in. You start to see, you know, there's a variety of things that look amazingly similar to things that we saw in the past. You know, you have the whole notion of unicorns, which is the companies that are now, you know, multi-billion-dollar private rounds, more than we've ever seen before. But at the same time, we're seeing the emergence of the undercorns, right? These are the companies that raised a private valuation at more than $1 billion, and now are raising a public round at less than $1 billion, or less than their last private round, right? And so that's another, there's many, many signs that we're at a point where valuations are high. Now, the question is, it's only a bubble if it collapses. And,
Yeah.
and the question is, you know, is that valuation going to fluctuate? And if so, when? And that's really, really hard to say. But I expect that we will see probably a correction in some of these overheated sectors. You know, there's too many companies, I think, that are, you know, with very, very high burn rates without necessarily customers or the traction to support those next rounds.
Well, perhaps just in terms of a version of numbers, classic VC year is 1,600 to 3,500 corporate investments.
Yeah.
I understand last year was 5,471,
Yeah.
the latest stat. So perhaps the law of numbers
Yeah,
makes
and what's
you just
even
think
more,
about it.
you know, concerning is it's that the dollars per investment per round, right? So in the Series A, you know, those used to be X, now they're 2X. The Series B, and you know, those used to be X, are now 2 or 3X what they were. The Series C, same thing. You're seeing just a massive, not only the number of deals, but the valuations, the average valuation at each level. And so either you believe that it's different this time,
Right.
or and that there's something fundamental that's changed, or you know, or things are going to you know, revert back.
Pattern recognition again,
Yeah.
please.
Hi, I'm Cindy Walker-Peach. So my question is, why no medical? Just too easy for y'all?
You know, again, we're just getting started, and you know, we're focusing on those areas where we think we can have the most impact on the company right now with a very, very small team. You know, that said, Dell is a market leader in medical, and I would like to make some investments in medical, probably more on the IT side than on the device side, because I think we can bring a lot to those kinds of investments. But we're just scratching the surface of what we can do.
Well, I think, Jim, as you said, there's a limited number of people on the staff today. It's only been 3 years into the process of Dell Ventures.
Right.
So it's still early in the evolution of any firm.
Exactly. And so, you know, I mean, we're able to impact, you know, for example, just give you an example of where we are having impact. Security, you know, our Vice Chairman, Jeff Clark, talks about being able to offer the most secure PC. That's really important, it's really fundamental to what we're doing, and we're doing that through an investment in a company we have called Invincia, which handles advanced persistent threats that can't be handled by McAfee or Symantec antivirus. And so we've signed an arrangement to install that and ship it on 10 million PCs, ship it out. That's going to generate it's going to allow us to deliver on that most secure PC strategy. Our customers win, the investors in Invincia win, Dell wins. And that's the kind of things that's just so close into our core that we're working on those first, and then eventually things like medical.
Thank you.
Hi, I'm Claire Arthurs. I'm an MBA student at Texas, and my question is about the participation of women in the venture capital industry.
Right.
So there's been a lot of controversy recently with the Kleiner-Perkins case, and I was just wondering if you could comment and share your thoughts about sort of the future of venture in that regard.
Absolutely. I think that there's to say the least, there's an opportunity that the industry has to, bring more women into the industry, and I think the industry would be a lot better for it. We take it seriously at Dell. We've got something called the Dell Women's Entrepreneur Network, where we're actively promoting women entrepreneurs. I'm actually going to be going to Berlin to speak there when we're bringing women together from around the world. I think there are some early cracks, if you will, in the foundation of the business that are going to be leading to more opportunities for women in the business. There's an announcement that's coming up by another major firm that we co-invest with that's going to be launching a fund around diversity, that investing in those entrepreneurs, and I just think that the industry has there's a real opportunity, and the industry would benefit by taking advantage of it.
Thank you.
Sir.
I wanted to talk a little bit about your time commitment with each venture capital transaction.
Mm-hmm.
You mentioned that most of your transactions are about 4 weeks. You said 8 weeks.
4 to 8 weeks. Yeah.
But your interaction with the investors, with the companies themselves, and with the people you're investing in, I would understand that to be a little bit different for a corporate VC than for most VCs that are taking seats on boards and things like that. Can you talk about the things how much your time commitment is to each of these companies you're investing in, and how you may compensate to maybe less time spent than general VCs?
It's pretty extensive, actually, and just in the same way that we have, for each area we're investing in, we've got this cross-functional program. We've got a whole discipline around how we manage our portfolio. And so we train up the board observers to make sure that they're attending every board meeting, that they're meeting with the executive team either before the board meeting or afterwards, that their role is to act as the advocate or the champion for that company within Dell and outside of Dell. And so they spend a lot of time interacting with the business units and looking for new opportunities to plug that company in somewhere within Dell that it wasn't before. And then each quarter we have a fairly structured process where we will kind of summarize, what does this company do? Why did we invest? What did we think was going to happen from a commercial standpoint? How's the company doing versus plan? How are they doing versus what we thought was going to happen in the business units? What are the actions that the business units can take? What are the actions that we can take to help make this company more successful? So it's actually, we spend a lot of time. I couldn't quantify it, but it's a few hours a month per company at least for that board observer, plus all the management review.
It's quite a lot.
So we're pretty active.
Good.
Thank
you.
you. And this will be our last question for the evening.
I'd be interested in your thoughts. When we were raising venture capital in our space, we looked at a number of the corporate VCs that operated in that area, and there was always the perception on behalf of us and a number of other entrepreneurs that if you take money from one of those corporates, and you may have a range of their peer group or competitors who may be your potential acquisition targets in the future, even having one of them as a board observer or even a minority would somehow affect that. I was wondering what policies or thoughts you've put in place to sort of help entrepreneurs say that obviously if it's like an analogous business and you're selling to a non-Dell competitor, and I agree Dell could definitely add a lot of value, but have you thought about how you can sort of
Well, you know, that is a fair consideration, right? You know, if Dell's an investor, how are other companies going to perceive it? And by the way, how does Dell perceive it if another corporate is an investor? But, you know, some of the things that, and every entrepreneur needs to consider that, but some of the things that they can look at is, you know, we co-invest with a lot of our peers and then sometimes our competitors in the industry. They're fine with it, we're fine with it. Sometimes it even broadens the syndicate to have multiple firms, and we've got a few examples already of companies that we've invested in that have been acquired by others, and we signed the papers. You know, I mean, it's like we're fine with it. We know we make money when that happens, right? You know,
Yeah.
And so we're very motivated, you know, for the success of the companies. And so as that reputation gets out there that we're a strategic investor and we're looking to bring strategic value. And that we can and we have, and we're also interested in financial return, and we're going to really avoid anything that's going to constrain the opportunities of the company. You know, that gets out and people get more comfortable.
No rights of first refusal.
No right of first refusal, and you know, but notice is something that actually is pretty standard these days. Refusal puts a chilling effect on the company because it's basically the offer to match the last bid. But just the opportunity to know, that's what right of first refusal is, but right of notice is different. That is, if there's an offer that at least the investor knows about it so they have the opportunity to respond, that's actually good for the company because it really encourages everyone who has that notice to put their best foot forward and increase the value of the company.
Thanks.
So yes, no right of first refusal.
Jim, you've shared intensely a lot of information, and I personally could ask you another 2 hours worth of questions. But to honor your time and to thank you for what you've shared with us tonight, would you all join me in thanking Jim Lussier, head of Dell Ventures?
Thank you.